right financial accounts is critical for staying organized, achieving goals, and building wealth. They lay a foundation for your financial life and should work seamlessly together. If you have all your money in just one or two accounts, that's a sure sign you're missing opportunities to earn more on your money. This podcast will review 9 essential accounts that just about everyone should have to manage money and allow it to grow, regardless of your age or stage of life. Welcome back. I appreciate you joining me for Money Girl episode 902. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, founder of the Money Stack, that's my Substack newsletter, and host of this podcast, Money Girl, with over 43 million downloads. If you enjoy the free content that we love creating for you, take a moment to rate and review the show in your podcast app. That would really mean a lot to me. And if you have a question about money, you can leave it on our voicemail at 302-364-0308. Don't be shy. I'd love to hear your question or comment. You can also visit lauradadams.com to email me directly. And while you're there, you can learn more about my books, courses, and the free Money Stack newsletter. All right, let's talk about these 9 accounts that you can use to manage your money more effectively. Number 1 is a checking account. While having a checking account might seem basic, FDIC data shows that about 4.2% of U.S. households, that's about 5.6 million adults, were unbanked in 2023. So they were without a bank or a credit union account. Carrying and storing large amounts of cash is not wise because it could get lost, stolen, or destroyed. While you might want to keep some cash at home, be aware that it is never covered by homeowners insurance or renter's insurance, even after getting damaged or lost after a natural disaster like a fire or a storm or hurricane. Instead, everyone should have an FDIC-insured bank or NCUA-insured credit union checking account to keep your money safe. And I'll explain more about those designations in a moment. Your checking account is, it's a workhorse. It's like the grand central station for your cash flow with income coming in and expenses going out. The best checking accounts offer many free services like online bill pay. I love that. I use that constantly. Remote check deposit, unlimited transfers, ATM fee reimbursement, and a user-friendly mobile app that all make your daily financial transactions a whole lot easier. I've been a very happy USAA customer for decades. I'll put a link to them in the show notes. I highly recommend them. They are available to serve the military, veterans, and their eligible family members. So if that sounds like you, I would encourage you to check them out. Now, if you're unfamiliar with credit unions, they offer highly competitive interest rates that you shouldn't miss. The main difference between credit unions and banks is that credit unions are nonprofit financial cooperatives, and banks are obviously for-profit businesses. Credit unions are owned by their customers, known as members, and banks are owned by investors or shareholders. Credit unions basically exist to serve their members, so they usually offer more competitive products and better customer service. Like most banks have FDIC insurance, which covers up to $250,000 per depositor per account type. Credit unions offer the same insurance amount through the NCUA, or National Credit Union Administration. The full faith and credit of the U.S. government backs both types of insurance. But credit unions are not allowed to serve the general public like banks do. Every credit union has different member requirements. Some limit membership to defined groups, like those living in a particular county or geographic area. Some might limit it to people working for a specific organization, like a military base, hospital, or school system. They may limit it to people working in a particular industry, like healthcare or education. Now, sometimes you can become a credit union member simply by making a small donation to an association or maybe a charitable organization. So check out what's available, in your area. Most credit unions do give automatic membership to the immediate family of existing members. So if you're not particularly happy with your checking account or, you think there might be some better options out there, I would encourage you to shop around. I think, it may seem like a hassle to switch banks, but if they give you higher interest or lower fees or, better user-friendly experiences, it can really be worth it. All right, the second account everyone needs is a savings account. Unlike a checking account that allows unlimited transactions, that may not be the case with a savings account. Now, you can make as many deposits as you like, but a bank can limit the number of savings withdrawals that you can make per month, such as up to 6 outgoing transfers. A high-interest savings account is the perfect place to put your money for short-term spending and goals like, holiday expenses, vacations, and emergencies. Some even allow sub-accounts for different purposes, which is a great way to segment your goals. Some of the best high-interest savings accounts currently pay about 4% APY, and that makes them excellent for building and maintaining a healthy emergency fund. While investing your cash reserve for higher returns can be tempting, it's definitely best to keep it entirely safe from risk so it's available when needed. So again, keep those emergency funds in a high-interest savings account. One option you might want to check out is called Raisin. I'll put a link to this in the show notes. It's a no-fee account where you can spread your money across the highest yielding accounts from multiple institutions. So with one secure login, you get access to over 70 partner banks and credit unions. I think that's a really great resource. All right, the third account is a business banking account. This won't apply to everybody, but you should have a separate business checking account if you have part or full-time business income. That's going to simplify your record keeping and make reporting and paying taxes a whole lot easier. Most business accounts allow you to create sub-accounts, and that can be terrific for setting money aside for required quarterly tax payments. When I have money that comes into my business banking account, I just automatically transfer a certain amount over to my tax sub-account so that it's going to be there when I need to make my quarterly tax payment. You could also create a holding account. That's excellent when you have irregular income, but want to pay yourself a steady amount that keeps you on budget. And I talk a lot more about holding accounts recently in Money Girl episode 899 called How to Budget with Irregular Income: 6 Steps for Freelancers and Self-Employed Workers. The fourth account is a workplace or self-employed retirement account. So in addition to having the right banking products, everyone should regularly use one or more tax-advantaged retirement accounts to invest for the future. You might need retirement income for decades after you stop working, so building your own investments is critical. Employers typically offer some of the most popular retirement accounts. You've probably heard of a 401k. They may also offer a 403b or a 457 plan. And many companies even pay additional free matching contributions, giving your account a nice boost. Now, if you're self-employed, you have your own options like a SEP IRA or a solo 401k to invest for retirement. They allow some of the highest annual contribution limits, making them essential for anyone with business income. I use a SEP IRA and really enjoy the flexibility that it gives me. It's available to anyone who is self-employed with or without employees. And a solo 401k is only for those who do not have employees except perhaps a spouse. Retirement accounts are powerful places to invest because they give you some really significant tax advantages. Traditional accounts give you an upfront tax deduction on your contributions and defer taxation until you take withdrawals. Roth accounts are kind of the opposite. They require after-tax contributions, but allow tax-free withdrawals in retirement, which is fantastic. Now, just be sure you won't need the money before the official retirement age of 59 and a half. Taking early withdrawals from a retirement account generally comes with a 10% penalty plus income tax on any amounts that were not previously taxed. All right, account number 5 is an individual retirement account or IRA. So this is great if you don't have a retirement plan at work, or maybe you're self-employed, or perhaps you file taxes jointly with a spouse and have little or no qualifying income. In all of those situations, you can contribute to an IRA. While you can max out a workplace retirement plan and a traditional IRA in the same year, limits can restrict how much your IRA contributions are tax deductible. And I did a recent podcast about this called Maxing Out a 401k and an IRA, Rules, Limits, and Tax Benefits Explained. If your income is too high to qualify for deductible traditional IRA contributions, I would consider using a Roth IRA instead. Since Roth contributions are non-deductible, meaning they're paid on an after-tax basis, there's never a problem or a conflict using a workplace retirement plan and a Roth IRA in the same year. However, Roth IRAs have an annual income limit to qualify. They are the only retirement account out there that comes with an income limit. For 2025, single taxpayers cannot contribute to a Roth IRA with modified adjusted gross income, or MAGI, at or above $165,000. Married couples filing joint taxes cannot contribute when they have household MAGI at or above $246,000. While a Roth IRA doesn't give you an upfront tax benefit, it gives you that tax-free income in retirement that I mentioned, so that's really a nice benefit. And the younger you are, the more your Roth contributions can grow, providing terrific tax savings. So if you're young and your Roth account gets, a whole lot of investment growth, all of that will never be taxed. So that's, why the Roth can be so powerful. But let's say you're a high earner, or maybe you're a little farther along in your career. You typically get more advantages from using a traditional pre-tax retirement account. And, you can always use both if you want a little bit of that pre-tax and after-tax money in retirement. All right, the sixth account that everyone needs is a brokerage account. Unlike retirement accounts that typically penalize you for early withdrawals and impose an annual contribution limit, you can withdraw funds penalty-free and contribute an unlimited amount each year to a regular brokerage account. However, the downside is owing tax each year on any account gains that you realize. Consider maximizing at least one retirement account annually. And if you still have more to invest, use a taxable brokerage account. It's an excellent place to invest for midterm goals, like maybe you want to buy a home or start a business in 5 or more years in the future, and you don't want to take an expensive early withdrawal from a retirement account. You can open a brokerage as an individual or as a joint account. And there are many to choose from, but Betterment and Empower are a couple of my favorites because they make it really simple to start. And I'll have links to those in the show notes. All right, account number 7 that may apply is a health savings account, or HSA. If you have an HSA qualified health plan on your own, or maybe you get it through an employer, you can open a tax-advantaged HSA to pay eligible medical expenses. Note that these health plans work best when you're in relatively good health and aren't likely to spend the full deductible annually. The beauty of an HSA is that your contributions are tax deductible, the account growth is tax deferred, and distributions are tax free if you spend the money on qualified, unreimbursed medical expenses. So those triple tax advantages can't be beat with any other type of tax advantaged account. Just like with a retirement account, you should never put money in an HSA that you might need for everyday expenses. HSA withdrawals for non-qualified expenses like groceries or, taking a vacation, they're subject to income tax plus a hefty 20% penalty. If you qualify for an HSA, they're available at many banks, credit unions, brokerages, and specialty institutions. Most are really convenient. They, offer paper checks, a debit card, and online banking, very similar to a, regular checking account. A couple of my favorites to check out are Lively and HSA Bank, and I'll have links to those in the show notes. All right, the eighth account that you need is a credit card. When used responsibly, credit cards offer many advantages, including convenience, purchase protection, an easy way to build credit, cashback and rewards, travel benefits, and a credit line for emergencies. However, carrying a high balance and making late payments can lead to expensive interest charges and negative marks on your credit report. So again, it all comes down to using credit cards wisely. There's no limit to the number of credit cards that you can or should have, but having at least two is wise, I think, so you have a backup if something goes wrong with one of them. And you can have as many cards as you feel comfortable managing and think will benefit your financial life. And lastly, number 9 are kids' banking accounts. If you're a parent, you might want a bank account for your kids. Kids' banking accounts have 3 main categories. There are banking apps, checking accounts, and savings accounts. Kids' banking apps offer some pretty innovative features that allow families to do things like automate allowances, set spending limits, restrict kids from shopping at specific merchants, set up a savings account that earns parent-paid interest, and teach kids all about financial literacy, teaching them to spend, save, give, and invest wisely. Greenlight is an excellent kids' money app to check out. Again, a link will be in the show notes. And kids' checking accounts are really joint bank accounts that are co-owned between a child and their parent or legal guardian. That's because most banks only allow you to open checking accounts for kids 13 or older. These accounts allow kids to make purchases in-store and online, and most are free to set up and get started. However, kids' checking accounts don't have as many parental controls or financial literacy tools as kids' banking apps. And kids' savings accounts are available for a child regardless of age if they have a valid Social Security number. And it's a joint account co-owned between a parent and a child, and it typically converts into a regular savings account when they turn 18. Each of the 9 accounts I've reviewed serves an essential purpose in your financial life, whether saving for a short-term goal, making an online purchase, teaching kids about money, paying healthcare bills, or investing for the future. If you don't have one of these accounts, you might want to shop around and see what's out there. Of course, not everybody needs all of these accounts, but if I reviewed some that you think would benefit you, I would encourage you to look around and see what's out there. Or maybe you have an account that you think could be better. You could be earning more interest or could be a little bit more convenient. There are a ton of choices out there. I've given you a few of my favorites, but certainly do your own research. It can really pay off when you have the right financial accounts. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our terrific team. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor. And I'm your host, Laura Adams.